Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to look at the EIA and OPEC following the OPEC agreement or extension from the weekend, and also to review what the EIA information was and what we think that means going forward. Now, we've been doing something that's been a lot of fun, which is the question of the day. And the question of the day is going to be, where do you see oil prices going over the next week or two? Have we seen enough to keep us here, or do you think we're going to go higher or have a pullback? We'd love to hear from you, and please post in the comment section and we can have some great dialogue going forward. Now, to really dive into it, we need to look at what is happening with the crude stock build. So again, we've talked about how you have to factor in the SPR, which is why we actually had a build of about 7.94 or around 8 million barrels. Now, this is something that's going to continue over the next week or two. We're starting to get towards the end of all of the Saudi crude that's sitting out there. I think we're at about 20 million with another, depending on how much is timing wise, about another 20 million to go. We're about halfway there. So the Gulf or the Gulf Coast or Pad 3 is going to be very important in terms of where this sits going forward. And the SPR still has space in terms of taking in new crude. So we have to look at what is crude stocks going to do going forward. And we continue to see a build really driven by Pad 3. Now, you're going to see headlines about how this is the biggest build ever. But when we look at things, we want to include the SPR. Now, we're getting close to all-time highs. But when you look at the SPR, you can see that we're still not quite there. So the headlines are going to be fun. They're going to say 500 some odd million in storage, which is great. But we want the true number, which is always going to include the SPR. Now, given the distance, as you can see from the chart, we're going to close that gap fairly quickly, and it should be within the next, let's say in the next week or two, based on Pad 3 and just production coming back over the next, let's say the next 2 weeks or so. We've had about 100,000 coming out of Bakken in terms of shut-ins increasing, and we have about another 500,000 of production increasing out of the Permian. Now, some of that will be offset by the hurricane coming through the Gulf, or tropical storm at this point, and that's going to equate to about 560,000 barrels a day. But because it's in the Gulf of Mexico, it can come back relatively quickly. So that's not something that's going to be a detriment to the total number. And that's why when we look at Pad 3, we have all-time high records in Pad 3. Some of that should be normalized a bit because of the loss of Gulf of Mexico. But again, just because we have those imports offsetting, we're not going to see that huge disconnect. But we really need to consider, again, what is happening in crack spreads, because crack spreads are really going to drive the day in terms of how much new demand is going to come over the coming few weeks. And crack spreads remain either at or close to the negative range. And the reason why is you have to factor in feedstock costs, which is the buying of oil, what kind of oil you need, shipping costs, storage costs. So when we look at all of this combined, there's still major headwinds across the globe when it comes to crack spreads. Now, again, this is just looking at the 3-2-1, which is 3 barrels of oil creating 2 barrels of gasoline, 1 barrel of distillate. And you can see that we're just bumping along those bottoms, which is the equivalent to 2007, 2008, which we all know wasn't the best time. 2009, which we all know isn't really the best time for crude pricing as we went into a recession. Now, when we look at imports, runs, implied demand, what does it mean going forward? The imports, again, increased into Pad 3. That was at 2.7 million. And that's going to maintain those levels. Things, go up and down. I don't know if you remember, last week we had a little bit of a pullback. This week we're going to have a little bit of a pullback just because there's timing delays. But as we have been saying, the refinery runs are going to be between 70 and 75%. Now, we've had an increase, and you can see that a lot of that was driven by Pad 3, which is why they need to marry the imports with refinery runs. But we did get new data saying that refinery runs are going to decline starting the last week of June as some of these guys pull turnarounds forward. And that just means doing work. So a turnaround is when you bring a unit offline and then you fix it so that it can work for however long, and extending that life expectancy. So those things are being pulled forward because we continue to see demand, weak across the board. Now, while we say it's been weak, obviously we had that big step up. Yeah, it was driven based on gasoline, but more importantly, that distillate fuel. Distillate fuel, jet fuel, they both had some nice recoveries. But again, these are things that are temporary in nature. We had distillate draws that increased a little bit. That in terms of where they should have been versus estimates. But the biggest thing was we actually had exports increase, and that was really driven by France, which we'll talk about in a minute. But implied demand had a nice little recovery. We think that this is going to normalize a bit just because, again, the seasonality gets harder as we go further into the summer. But it's really important to talk about, what are these imports going to do? So we can see that the offshore floating storage remains elevated. It's not at all-time highs. It is for the seasonal time, and more ships are starting to arrive. So we had some pullback in terms of crude coming off the water, but we're starting to see those some additional ships start to enter our waterways, which is going to keep us at this elevated level. Now, the other big thing going forward is going to be these imports, which are going to remain at about a stable level. We think it's going to be relatively average. There's nothing that's telling us it should adjust outside of maybe some weather issues. But again, weather is always transitory, and will be fixed on the following week. The bigger issue is going to be refinery utilization rates. Now, we've seen the recovery, but again, like if you look at the chart, and this is why we always look at things seasonally adjusted, you always get that shift higher. We always have an increase in runs as we go into the summer, and we're just not getting to that level, and we're not going to close that gap. And it comes down to shortage of storage, losing money across the board. I mean, for every barrel that's created into product is essentially just burning capital. So there has to be some rationalization and normalization to refinery runs, which is why we kind of hold between that 70, 75. We think we're going to get one more increase, and then you're going to start to see that dip off as we get into the back half of June. And when we look at okay, well, what are exports doing, and what is the implied demand doing? And this is why when we see, you can see the distillate actually increased in terms of demand, but it was along a seasonal norm. So you can see how we kind of dipped really hard, and then we had that recovery right around the same time that we had it in the lows. And it's important to appreciate that there's going to be a seasonal average. So we should see a decline, as I was saying, things will step off, but the question is going to be how big is that step off going to be? And we think it's going to be relatively large as the economy just continues to struggle to get that restart. That's always going to be signified based on distillate, because that's the biggest consumer, is going to be the supply chain, logistics, and the industrial sector. And now when we turn to gasoline, you can see that we had a recovery. Our view is that we were going to get to about 8 to 8.5 million, which is going to get harder as we go forward because we've already had reopenings across the board. We're starting to get some hotspots increasing in Arizona, Florida, and some other places. So while we get some guys coming out of lockdown, we get some cautiousness in other states. So you're going to always have this friction of, where is the gasoline demand going to come from? And that's why we think we kind of normalize and hit a little bit of a ceiling at about 8 million barrels a day of actual demand, which is going to kind of carry us through what we think will be the summer. We could get an extension to 8.5, but realistically, based on the numbers we're seeing in the miles being driven, that 8 is going to kind of hold, especially as we've had gasoline prices start to increase. And as gasoline prices start to increase, people may adjust and say, well, it wasn't as cheap as it once was, so let's slow down. And when we think about, okay, well, what about gasoline demand? Where was the demand over the past week? And even though we continue to see week-on-week increases overall, on a day-by-day basis, it fluctuates. So we actually were down, I think this past Tuesday, in terms of on the 7th, on when the last time we had data, we were actually down about 2% week on week, but we were up about 12% month on month. still down about 30% to 20 to 30%, depending on which area we're talking about in terms of year over year. And that's the big issue, is the year on year. And that's where we're going to continue to see those slowdowns, as we showed with that demand, and where we should be on a seasonally adjusted normal level. Now that we've gone through gasoline, distillate, we really have to touch on jet fuel. And jet fuel, as we've described before, or kerosene, can really get blended into either the gasoline or distillate cut. And now that we're starting to see a little bit of a normalization in air traffic, not to say that things are surging, but you are starting to see a little bit of a recovery, it's worth talking about what's happening in the jet fuel market, because we've talked about how distillate and oil builds were going to accelerate. They're continuing to accelerate. That's not going to stop, but the pace is going to slow, just because we're going to have a little bit less jet fuel getting blended into the distillate cut. And that's why it's important to look at how, where is the jet fuel demand? Now, given typically vacations increase, as they always do, as we go into the summer, so we're going to have harder comps, but we're starting to find this bottom. We're starting to see, this ebbs and flows, and it's going to be a little bit more consistent as we go forward, just because we're going to have a bit more consistent in terms of jet fuel demand based on, an increase in flights. How much those flights or how long those flights stay enacted is going to be tough, because again, like, people are still concerned about COVID, about flying. And if gasoline prices, while increasing, still remain here, maybe it makes sense to stay more local, go hiking, camping, whatever, instead of going to a resort or a destination on a flight. And that's where we really turn into exports. Now, we talked about how crude exports were going to fall to about 10.5 million to about 2.7. And we got to the low of that 2.5. Now, that's going to increase a little bit, and we're going to talk about OSPs in a minute on how Saudi actually helped U.S. exports. But we're going to have another week where we're going to be between that 2.5, 2.7 until we start to see a little bit of a recovery as, Magellan and LLS start to get a little love with Saudi making things a bit more expensive. But the bigger issue that we're going to look at here is distillate and gasoline. Now, gasoline, again, kind of bumping along the bottom. That's going to remain a problem. We're going to probably see a little bit of a decline in gasoline, but the distillate is where we got wrong. So I thought distillate was going to see a bigger decline, but I don't know if there was a huge price discount or something, but France came in and bought a huge slug of distillate. That took us to about a 3-month high. And it was a lot of that is going into France. Now, that can be resold, that can be moved elsewhere, but we did see that increase, and that should continue for another week. But most of this increase was realized. So even though we got an increase, we'll start to see that slow down. And to put it into seasonal terms, which I always think is important, we normally see a little bit of a seasonal bump, even at the lows. In gasoline exports, we saw that, again, something that's going to kind of flatline here, as we typically do, probably kind of pull back as we continue to see issues within Latin America, which is where a lot of gasoline goes from the Gulf of Mexico. But more importantly, it's going to be distillate, because we did have a counter-seasonal increase. Now, given you can see that we have these weird increases as we had back in April, we had another spike in early April, and again at the end of April, and we had something again here. This is something where if you need to clear out storage, you might offer a discount. You need to incentivize to move product to kind of backfill, and that's kind of what we had here, and that's why France came in. And at the same time, you do have Europe opening a little bit, and as we spoke about earlier, European crack spreads remain some of the weakest in the industry. So it might make sense for a refiner to not make the product themselves, but go out there and purchase it. So we could continue to see some of this maneuvering. We also have India talking about a increase in travel and in opening up the economy. So there could be less imports coming from Asia that we've seen. So we're going to start to see this normalization. We think it'll come down just based on flows going forward. But again, this is why we had a nice little increase, which helped keep the distillate build smaller than it was expected. And when I say smaller than expected, you can kind of see the breakdown here. So just to touch on gasoline. So gasoline built more than we thought it was going to build. And the reason why is we had, imports, which continued to be turned away. So they came to the U.S. East Coast and then were kicked down to Panama or the Caribbean because we just don't have the demand that was expected when those shipments were purchased. So imports, continue to kind of flounder, but at the same time, builds continue, specifically driven by the Pad 5, which had another big one, which was the West Coast, and Pad 3. Now, Pad 1 is interesting. Now, Pad 1 being the East Coast, because we're starting to see people come out of lockdown, but we're just not seeing the same driving demand. And it could be just that, the Northeast was really where COVID hit hardest, so people may be slower to really normalize. So that's something that's going to continue. But the other big one is distillate. Now, distillate had a relative draw out of most places except the East Coast. That's something that's going to change as we go. We think Pad 3 is going to have a little bit of an increase. Gas oil prices have recovered a touch. But again, those are things that are going to normalize over time, especially when we start to think about what's happening in the global market and on a broader scale when we start looking at both product as well as oil. So just to review before we jump into OPEC, we really have to consider, what's going to happen in EIA going forward. And we continue to see builds in both distillate as well as oil, which is going to continue to weigh across the complex. Gasoline is going to waffle, but realistically, we're not seeing enough to get refiners to really turn that corner and to really ramp up. Gasoline prices remain low, distillate prices remain essentially non-existent, and those margins just aren't enough to really get guys to increase that demand. And that's why when we really start to turn into the OPEC deal or the extension, we really have to first start with OSPs. And as we've talked about, OSPs is just the official selling price that's stated. Now, Saudi raised July prices anywhere from $1 to $6, depending on where we're looking at. I mean, even to the Far East, you had super light at about $7.30 increase between June and July. This is going to hinder new demand. We've had China that has come across, and we'll show some charts on it. They've come across and just sweep the market in May. They don't need to come back. Now you're starting to see this weird move of, well, why are you doing this? And these increases is actually putting U.S. crude back into play. We've seen some purchases from South Korea. We've seen purchases from China. Just because now at this OSP level, some of these other grades make sense. We think that under this metric, the U.S. and both Russia will pick up some additional exports because the Saudi is just kind of pricing itself out. Now, given they can make deals, there can be something underneath it, but it's just very strange to see this move, especially given how hurt refiners are. And that's really what it comes down to. Where is real sustainable demand going to come from if we have a global glut in refined product, and now you're essentially tightening the screws? And it could be they want these refiners to sell from storage, but again, it's going to take time to figure it out. And especially when you look at the OPEC deal. Now, the OPEC deal was renewed, if you will, over the weekend, where they decided to extend it into July. Now, the original one was for a cut of 9.7 million in May and June, but now it's a 9.6 million cut in July. Now, the difference of 100,000 is Mexico leaving, but the bigger focus, and this is just looking at April into May, you can see that they missed May by about almost a little over 1 million barrels a day. And it was really driven based on Nigeria, which was non-compliant by about 282 million barrels a day. But the other bigger one was Iraq. So Iraq was non-compliant by about 600,000 barrels. Now, these are things that in order to get the deal or the extension in July, they had to agree to cut for a longer period to make up for their non-compliance in May. Now, the other thing that is going away was the additional voluntary cut of 1.2 million barrels, with about 1 million barrels being taken by Saudi and the additional 200,000 by Kuwait and the UAE. Now, this 1.2 million was decided to only be in June. So in July, those barrels will be coming back. So far, Nigeria still remains non-compliant in terms of what we know. Angola is slightly non-compliant, but they're going to continue to do that and probably won't make it up because China is their main buyer. And just based on how Saudi price themselves, they can still be competitive into that market. So these are things that we're going to have to keep an eye on because the glut still remains. We're still in a net building territory, even though during the summer months is typically when we start to see these drawdowns. So July is going to be interesting to see how compliant is everybody, because right now we're about 77 to 80% compliant for May. June, hopefully we're going to see 100% compliance, but again, we know how this game is played. So we don't think it's likely, but we'll keep an eye on it, especially when we're watching those boats. And that's why when we look at the global pace of inventories, we continue to focus on US, Japan, Fujairah, and then we'll go through some of the others after this, but you continue to see the builds. Now, the pace week over week slowed a little bit, but again, it's still moving in the wrong direction, and it's really driven based on this week. US and Japan were the biggest increases. Fujairah kind of moved sideways. There was a little bit of an adjustment there. But anytime Fujairah seems to have an adjustment, there's actually a big increase. So we'll have to see how that looks week over week. But Japan, again, continue to see the increases. Refinery utilization actually went down. So we would expect to see another build in oil. But again, crude and distillates continue to outweigh any type of price improvement that we think could be sustainable. Now, China was the big one. So China essentially, like if you look at this chart, you can see March and April, they had that big dip. And it was really because obviously COVID, and they delayed all purchases. So they delayed purchases that wasn't contractual, and they tried to even move contractual out of March and April. So May, they were already net short for what they needed, given what they were going to bring refiners back on. Now, it's important to consider China is sensitive to price, as is everybody. Now, to appreciate, the average price they bought the crude at was 27. The average price in Brent is 41, and right now WTI is 39. So just to give an idea, 27 versus 39 or 41 is a huge difference. And that's something to be considered as we go forward. We already have refiners starting to slow down a little bit. They had a big run. Now they're starting to pair off. Shandong is seeing a big increase in terms of crude in storage. And it's important to appreciate May doesn't have to continue. We had a nice bump year over year, month over month. But again, now we can start to normalize as prices move out. And we can see it's like, well, how much are they going to normalize? And here you can see, just as an example, we can do this for every port in China. You can see there is a ton of crude just sitting in the Shandong province waiting to unload. And this is why we think that, even though May was strong, you still need to normalize. You still need to get this crude off of a boat and into port, and whether that's into onshore storage or into a refiner. And that's why the next thing is like, okay, well, we talked about India, we've talked about China. Now let's look at India as they start to come back from their slowdown or their lockdown. And here you could see that Indian oil demand growth still was terrible. I mean, not surprising, year over year. But again, it was better month over month, because last month was really the peak in terms of lockdown. But we still have a slow ramp up of refiners. So some refiners are going from 0 to 35, some are going from 40 to 80. But again, it's kind of a mismatch as to which provinces are coming out first. And this is something to watch, as we do have a recovery, but refined product demand remains down 20 to 40% depending on province. So that's something that's going to weigh on how quickly that oil demand comes back. And that's why we have to look at oil in storage across Asia. And here you can see that we actually had that big surge even after we had that little normalization, let's say 2 weeks ago. And that is really being driven by China, because China went through, they bought a huge amount of crude throughout May, and now it's showing up at the shore, and it's just sitting there waiting to offload, which is why we think it's going to put weight on what June and more specifically July purchases will look like. India, depending on how fast they come back, will kind of indicate how quickly that comes off. But again, it's something that's going to be an overhang as we go forward, especially when we consider the worldwide crude floating storage. Now, we touched a new all-time high. It's pulled back a little bit, specifically out of the North Sea. And, I think it was the North Sea and West Africa. But again, we're still at, these elevated levels, which is going to continue to weigh on pricing as we try to find buyers or people that can onboard this and turn it into product. But you have a product storage glut, and then product storage glut is so much onshore that you're getting it to go offshore. So you can kind of see how the supply chain is going to take it time to work itself out. Now that we've looked at the EIA data, we've gone through OPEC and looked at global storage. Now on Friday, we get to talk about economic data, which is really going to impact where demand's going to go and where we think U.S. production is going to end up. And who can talk U.S. production without talking the primary vision frac spread count? So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.